So the Bank of Canada has just decreased its key overnight lending rate for the first time in 4 years. But what does that really mean for your household? Not a whole lot if you consider the average Canadian mortgage, which is just impacted by an $800 decrease over the course of the entire year. Keep in mind it's just a 25 basis point decrease that occurred, but it does signal a broader change in tone. See, the Bank of Canada has increased interest rates for 10 consecutive meetings, and this is the first decrease. So it's really a turning of the page and a shifting from an increased tone to more of a decrease. See, looking back in history, every time the Bank of Canada has started its decrease interest rate cycle, this cycle has lasted anywhere from 12 to 24 months, with decreases sliding considerably from their peaks. So should we expect another decrease next month when the bank meets to decide if it should change the interest rates? Most experts agree that yes, there will be further interest rates coming in the next few months, but if you look further out to the 3, 4, 5 month timeline, things get a lot murkier. It's a lot less clear on whether reductions will take place. So the future may be a little tricky to predict from where we're sitting right now. But what we can do is look back at the past and see what past Bank of Canada announcements look like. This chart over here represents the last 24 years of Bank of Canada increases and decreases. It's straight from the Bank of Canada website, and it gives you a clear look at some peaks and troughs and some significant events that have taken place in the last 24 years. Right over here is the dot-com bubble when the rate was almost 6%. The BOC started slashing rates to stimulate the economy and brought it down to 2%. The next major event was over in 2008 with the financial crisis. Again, the BOC started slashing rates to stimulate the economy and brought the rates down to a historic low of 0.25%. It hovered in and around the 1% range for the next 10 years or so until the pandemic, when again the BOC started slashing rates and brought it to the historic low of 0.25. We all know what happened after there. 10 consecutive rate hikes took us up to 5%, and where we are today is 4.75%. One decrease just occurred, and then the future from here, most experts agree we won't be going as low as 0.25 like we did in previous decades, but we will be going significantly lower. Now, you might be wondering what effect these decreasing interest rates will have on average home sale prices. For that, we have a chart, the chart of average GTA home prices over the last 24 years. We can see a clear growth of pricing over to the top right over here. In 2022, we reached the peak of the market when interest rate increases started to take place. Pricing came down drastically and kind of flatlined since then. Where do we go from here is really anyone's guess. Now, immigration has been on the rise in recent years, with Canada taking in more than 1 million immigrants in the last year alone. This chart illustrates the large spike in immigrants we saw in recent years. Now, recent legislation aims to curb some of this immigration growth, but we still see over 60% of immigrants choosing the Greater Toronto Area as their final destination for them and their families. Ontario has made headlines promising to build 1.5 million new homes by 2031. But data we have from the Altus Group shows that those figures are going to be very difficult to achieve, especially since housing starts have actually decreased in 2023, 2024, and the trend looks like it's going to continue into 2025. This creates a significant gap between the amount of housing that is needed in Ontario to the amount of housing that is being supplied in Ontario. Here is another chart that highlights the same information in another way. This chart represents the ratio of growth in the working age population to the housing starts. Right now in 2024, you can see that there's almost 5 people of working age population for every 1 housing start. Not a great ratio for a province like Ontario, and why the government is pushing to build those 1.5 million homes. Now, these forces have led to significant pressure on the real estate markets in and around the Greater Toronto Area. We've seen the return of multiple offers to townhomes, semi-detached homes, and detached homes. The condo market, however, is behaving a little bit differently, with condos sitting on the market for weeks at times, and price decreases have become more commonplace. There's one piece of advice I'd like to share with condo buyers sitting on the sidelines and deciding whether they should make a purchase in today's condo market. And that is, condo prices and house prices usually travel within a similar delta. House prices go up, condos jump a little bit higher. House prices go even more, condos go even more. But today, the difference in price between a condo and a house is the largest it's been in over 10 years. This presents a good opportunity for potential buyers because I suspect that the farther interest rates slide, the faster condo prices will start to rise. And if you're ready to make that purchase, you need an experienced real estate agent in your corner to represent your interests. And that's where I come in. My name is Philip Kotlier, and I help families move across the country, across the world, or just across town. Whether it's in 8 days or 80 days, just give me a call. I'm happy to help you make your move everything you want it to be. Now, what did you guys think of the Bank of Canada's interest rate announcement? Was 25 basis points enough? Should they have gone a little bit higher? I'd love to hear from you. Feel free to leave a comment in the comment section below. Moving forward, we're putting out a video a week about everything to do with living in Toronto, including neighborhood guides, property tours, and real estate stats. So don't forget to like and subscribe so you can be the first to be notified when a new video is released. That's it for today. We'll see you guys on the next one.